Hey everybody, thanks for watching. This is my friend Kristen Eck. She's an independent mortgage lender with New American Funding, and she's my favorite mortgage broker.
Thank you.
And today we're going to talk about some real estate 101 stuff, some very basics, but stuff that you really need to know. So Kristen, tell us the 3 things that you're going to need to get pre-qualified for a mortgage.
Okay, the most important things for me is to obviously take a look at your assets and income. So the 3 main pieces of that are your tax returns, 2 years, your W-2s, which go with that. That's what your employer gives you at the end of the year.
Right.
And then bank statements. I need 2 months of your bank statements, any assets, retirement funds, brokerage. Even if you're not going to use them for the loan, it's helpful just to know that they're there. And then I can kind of crunch those numbers along with your credit and sort of start really building a picture of what you might be qualified for.
I'm thinking about buying a house. What do I do?
So what you do first, call me.
Yes.
I build out your file, your pre-approval. If there's any last little bits, if there's any questions, any weirdness in the file, you know, if a wife pops up you didn't know about, we'll talk about that, right? It happens all the time.
A wife pops up.
You'd be amazing what I find when I start working with people.
But anyway, you're ready to buy a house, you call Kristen and you get pre-qualified.
Yes.
It's very simple.
Yes. Sometimes you think you're 2 years off from buying a house.
Yeah.
You know, I'll take a look at your stuff just so we can get a game plan together. And then I've had people who thought they were that far from purchasing by in 2 months.
Right.
Because they just don't know.
Okay, so
yes,
we've got a lot of cameras here, and that's because most of the people that I know are from the entertainment business, right? And they are a rare breed to a bank. We don't look good on paper because we're freelance. You know, we don't have a 9-to-5 job, and sometimes it could be a little tricky getting pre-qualified for a loan. What do I do?
Well, I mean, the first step is to talk to a lender who understands the entertainment industry and who has support that understands it. So we have special underwriters who just underwrite entertainment files. They understand that you guys have gaps in employment, and that doesn't mean that you're not working. It means you're in between your jobs or you're waiting for a job to start. Because a lot of times you walk into a bank and they just don't know how to qualify that kind of income and they get scared. So we look at that income more as sort of an hourly, more of a W-2 borrower. Because you are, at the end of the year, you get a bunch of W-2s from a bunch of different companies.
Right.
You're technically self-employed and we get all that. We want you to borrow.
Right. So I make good money. I think I could be a homeowner in LA, but I don't have the down payment. What do I do? We need some tips.
Number 1, take a walk of shame through your bank statements. Like, be brutal. What are you most embarrassed about the money you're spending on? Are you sending Jimmy from Uber Eats through his entire acting school? Like, you don't need to do that. You don't know how many borrowers I've asked, hey, what's this $50 a month charge? And then it turns out it was something from 5 years ago that they've been meaning to cancel. That's $600 a year that you're just letting walk out the door.
So take that walk of shame.
Yeah.
Like you're in college.
Own it. Strut through.
You could also stop paying for cable.
Yeah, a lot of people are cutting the cord.
By cutting that out, you could save probably $100 a month.
Yeah, it's tip number 3.
Tip 3.
Auto deduct your checking to savings. Say you want to save, I like to do it weekly, so I'll say like $50 a week, just put straight to my savings. Because then I don't even see it, I don't even know it's there, and it just goes.
Now, a lot of people, like, they have money in their checking account, but they don't ever pay themselves. You know, we used to put it in savings, right?
I love that. Pay
yourself first. Yeah, I stole that. I read it in a book called Profit First.
It's the first time I've heard it.
Yeah,
so
but you should always pay yourself.
Pay yourself.
Right.
I'm going to steal that from you.
Yeah. So this is something, if you haven't learned anything yet from my silly real estate karaoke videos, this is the thing that you need to know. Debt to income ratio.
Debt to income ratio. DTI in the biz.
Or your DTI if you're in.
Yeah, we'll use the shorthand.
How do you calculate your DTI?
You take your monthly revolving debt. Usually it's things like your credit cards, student loans if you have them, car payment. Those are usually the big ones. And so all you need to look at is that minimum payment number.
Right.
So I don't care if you owe 20 grand on your car. What's your monthly payment?
They don't care about the amount of debt. They just want to know what your monthly payment is.
Exactly. So you take all those numbers added with your hypothetical new monthly mortgage payment, and you divide that by your gross monthly income. So your income before taxes are taken out.
Right. That just shows the bank that your debt to income ratio
is sustainable, that you can afford what you're borrowing.
Right. Debt to income ratio. This is a song about the house that you're going to buy. Yes. You're going to be so thankful that you did it. You're going to just stand in the shower.
an emotional bath.
Wow.
Yeah, I felt that.
That song was about the first house you bought.
Yeah.
You know?
Yeah. It
You'll
is.
always love that house.
You will. It sticks with you.